Fed flips the election narrative. This is a chart of the euro-dollar butterfly. What is going on in this chart, if we cannot bring it up?
Yeah, so basically this white line shows the tightening that is priced for 2017 minus the tightening that is priced for 2018. So you can see in the chart what happened in the election. This is the first part we circled, is that traders thought that all of a sudden the tightening outlook for 2018 had gotten a lot bigger, and 2017 not so much. So the presumption was that, fiscal stimulus will take a while to work through. You might have a new Fed chair in 2018, so we might see a faster pace of hikes. And then you can see later on this week, the Fed meeting, that narrative really kind of flip-flopped, and now traders see a faster pace of tightening in 2017 than in 2018. So it's kind of like the exact opposite.
That's very interesting, because the most of the media narrative has been more inflation, higher rates, solidly since November 8th on, but there really have been two distinct phases to how the market has perceived that.
Right. There was a presumption that, the Fed was kind of going to wait and see the effects of the Trump administration, and that's exactly what Janet Yellen said in the press conference. But still, when you added everything up that we got from the Fed on Wednesday, that's kind of not the message that traders took away from it.
It seems like the Fed can't win, right? They want to impart this message that it's very much wait and see. We'll have to see how it goes. We don't want to commit to anything too much. And yeah, given the way that the economy is going, 3 rate hikes might be appropriate next year based on the median dot. Nevertheless, traders have taken on a position regardless on what they think will be the outlook in 2017 or 2018, even with all these unknowns.
Yeah, exactly. So it's going to be really interesting to see how it plays out, because, we're getting a lot of movement right now, a lot of confusion, a lot of uncertainty. And you can see that, we're really being pulled in different directions week by week. So it's
all right,
an interesting time.
We have a second chart here, and it has to do with real interest rates, so inflation-adjusted interest rates. And if you come inside the Bloomberg, this is #BTV 5376. And what we have is the white line is the U.S. 5-year real interest rate, currently at 0.2359%, and then the blue line is the S&P 500, and as you know, it's hovering near record highs.
Yeah, so it's pretty interesting because, throughout the course of the year, and especially the last month or so, the market has been slowly pricing in that December rate hike because the Fed has been telegraphing it. They don't want to do it all at once. But in fact, we got a 25 basis point rate hike this week from the Fed decision, and so apparently it wasn't all priced in, and we actually did get that hike that we didn't get in the same way last year. But this chart, I think, really illustrates a key point, that is, whenever 5-year real interest rates have gone positive in the last few years, it's been a tough ride for stocks, and that's the blue line. And so you can see these shaded areas. I think this is a major question now going forward. Can the market handle positive real interest rates? It hasn't demonstrated the ability to do so yet. And so this is going to be a big test.
It's interesting you say that, given that so many people, when we ask them what is the effect of an interest rate increase, 25 basis point rate increase on the real economy, everyone dismisses it as, it's not going to make a difference at all. And yet when you adjust for inflation, the reality is very different, at least for asset prices.
Yeah, this has really been a sort of line in the sand, like a Rubicon over the last few years, that, the question is that they drove real rates deeply negative through QE, over the course of the zero bound period to add more stimulus. And can you unwind that successfully without causing a lot of market turmoil? That remains to be seen.
Hey, speaking of unwinding, final chart here, the Fed stealth reserve shrinkage. What are we looking at here?
So I think this is another really underrated storyline right now. So the white line shows the Fed's balance sheet, right? And you can see that that's been held constant since they stopped buying new bonds.
And that's by design. Every single Fed meeting, they talk about how they're going to maintain the size of their balance sheet.
Right, exactly. But the pink line here shows currency in circulation. And so this is a big component of the Fed's balance sheet. And you can see how that just kind of grows naturally, right? And so by keeping the size of their balance sheet constant while allowing currency in circulation to continue growing, they're actually draining reserves out of the banking system. And that's the purple line here. And so you can see that the blue line then is the total size of the balance sheet minus that currency in circulation. So that's the amount of high quality quality liquid assets that are essentially being furnished to the financial system, of which reserves are a big component. And you can see that's now under $3 trillion as of the last few weeks. And so, there really is a component here where reserves are coming out of the banking system, high quality liquid assets are becoming scarcer.
So that top line, the white line, is really not the line people should be looking for to get the sort of the economic sense of the balance sheet. I mean, it is the nominal sense, but in terms of the economic impact, you should really strip out that currency in circulation. And it's not dramatic, but there is a decline.
Yeah, exactly. And so, you kind of have that quantitative tightening going on as well as the price tightening.
Is this something that you've heard Fed officials talk about? Did they refer to this? Do they think about this?
Yeah, so actually the thing that got me thinking about this chart today was you guys may have seen Jim Bullard gave an interview to the Wall Street Journal in which he was saying he thinks they should start shrinking the balance sheet already next year, which is like very, very sooner than anyone else is talking about doing it. And so that was kind of an interesting thing to hear from a Fed official. Of course, he's one that wanted to start shrinking the balance sheet before raising rates, so he's had this idea for a while. But if that comes into play in 2017, then there potentially will be a lot of fireworks to watch.